Hi everyone. So welcome to the stream today. Very much excited for having you today again on the day 4 of our executive revision masterclass in relation to that. Um, Today is day 4, and we are looking at the financial reporting standards, or what we call the accounting standard series. Yesterday, we saw a couple of standards I discussed, to be specific, IFRS 15, revenue from contracts with customers. And then also I spent some time on IAS 12, income tax, in relation to that. So today we want to continue, and yesterday we had a lot of other standards listed. If you joined the stream, give me a thumbs up on the video and comment in the chat box what standards you want me to look at today, what standards you want me to look at that in relation to that. So comment below in the chat box, give us a thumbs up on the video. That way we get more engagement on the video, and we will be able to reach others as well. Then YouTube will be able to push the video to reach as much people as possible. If you know somebody that must be on this stream, that must watch this video, share the link with them, let them join the stream so they can also ask their questions. So together we can reach as much students as possible. Remember, my objective is simple: to be able to assist you, explain concepts to you, provide you with the assistance that you need in order for you to study, and most importantly, pass the exams and ultimately become successful and take your life to the next level. So I'm very much excited, very pumped up today, because we're going to be looking at some of the standards as well to be able to assist you to prepare well for your examination in relation to that. So comment in the chat box any questions that you have. So comment in the chat box and let's see what we have today. Okay, so I see thumbs up on the video. Thank you very much. If you have not hit the thumbs up, if you have not subscribed to the channel also, make sure you subscribe to the channel. Every single day I'm releasing new lecture videos or coming your way live to teach you and answer your questions for you, provide you with the assistance. So if you have not subscribed, subscribe and join, become a VIP member on the channel, so that way you will be the first person to be notified of changes in relation to that. Okay, so yesterday we started with the discussion on the IASs. So let me just share my screen with you real quick. So yesterday I mentioned that there are some core accounting standards that you have to focus on as a financial reporting or a corporate reporting student writing ACCA F7 or the ACCA SBR Strategic Business Reporting Examination or Advanced Financial Reporting Examination in relation to that. And I gave a list of some accounting standards that you have to focus on and make sure you understand even before you enter the exam hall in relation to that. Now, today I want to look at some of the other standards that were listed yesterday. I think yesterday we had IAS 36, IAS 23, IAS 13, IAS 12. I think IAS 16, something came up on that as well. And then IFRS 15, and I think IFRS 10, business combination definition for consolidation. This is 15. Yeah, so these are some of the standards that we saw listed in the chat box yesterday of you guys wanting me to take you guys through. Yeah, Ebenezer, thank you very much. I see a thumbs up in the chat. Give us a thumbs up on the video itself as well, and then share the video, and let's get to many students as much as possible. So which of these standards do you want us to look at today? Which of these standards do you want us to look at today? Indicate in the chat box. Let's see which standards we can look at today. Now, yesterday we saw IFRS 15, and then we also discussed the issue about IAS 12, income tax. And like I mentioned, Collins Adebayo, okay, see a thumbs up in the chat box as well. Give us a thumbs up on the main video page as well. Thank you very much for taking time to join in the broadcast today. So I want us to continue with our discussion on the accounting standards. Remember what I told you, and keep this in mind all the time, that definitely you in the exam hall, you're going to have a standard question on the accounting standards. And then in addition to that, in the preparation of the single entity financial statement, you are going to be faced with a question on the accounting standards. So every footnote you see is actually an accounting standard. So you have to understand how the treatments are done, how the various recognitions are made, because every element on the face of the financial statement, assets, liabilities, revenue, capital, all of those things are recognized based on the accounting standards. That is why when it comes to financial reporting and corporate reporting, my topmost area or my topmost priority area is to look at the accounting standards in relation to that. Okay, so Emmanuel J in the chat box is saying IAS 16, that is property, plants, and equipment. Okay. Any other thing, any other standard that you want us to look at today as we continue with our discussions? So I'm taking IAS 16. For those of you who are watching online, what else do you want us to look at? Let me just fix this chair well. Then Collins Adebayo is saying, what's that? Computerization in PPE. Please use an aircraft as an example or any other asset. Kindly assume zero knowledge, please. Collins Adebayo, I don't know, what do you mean by that? Are you talking about compound assets in like PPE? So like aircraft that has different parts, how do you depreciate it? Is that what you're saying, Collins? Nifimi Collins from Nigeria. Okay, Collins from Nigeria. Thank you for joining. Okay, so it means we gotta go through IAS 16, I guess. So let's start the day's journey real quick with IAS 16, property, plant, and equipment. Like I mentioned, whatever questions you have, put them in the chat box. I'm reading all of your comments and then I'll be replying to them as well. Okay, so Collins is saying yes, component in assets. Okay, compound assets in relation to that. Michael Darko is saying IAS 12. Michael, we discussed IAS 12 yesterday. Okay, we discussed IAS 12 yesterday. So after this stream, you can go and watch yesterday's lecture. We discussed the IAS 12, or you can check the channel page itself. I have almost 45 videos on the accounting standards in a playlist titled Accounting Standard Series, and there are lectures on that. So yesterday we spoke about IAS 12. So Michael Darko will not be talking about IAS 12 today. We spoke about that yesterday in relation to that. Then Tony Sape said IAS 23, that is borrowing costs. Okay, that's awesome. That's awesome. Any other standards? All right, thank you guys for the thumbs up on the video. Bernard Corbena, you are welcome. I believe you're doing well. Thank you for joining the stream as well. Okay, so let's start the day and let's look at IAS 16. And as I'll be talking about IAS 16, we're going to be boiling it down to IAS 23, the borrowing cost. Okay, for Stabasios is also here. Okay, so everybody is rapping straight up. Okay, Bernard said yes. All right, we thank God. Give us a thumbs up on the video if you have not, and then make sure you subscribe to the channel if you have not subscribed as well. And share the video, right? I want you guys to share the video. So share the video with your friends, your colleagues on your WhatsApp platforms, your Facebook groups, so we get more people to be able to watch the channel, because we want to grow the channel, all right, so that we will be able to reach as many people as possible. Right, so let's go into it. IAS 16, property, plant, and equipment. This is by far one of the fundamental accounting standards when you are going into the exam hall as a financial reporting or a corporate reporting student. Why? Because whether you like it or not, there is a statement, a footnote, or a standalone question on IAS 16 that the examiner is going to be hitting you with. But like I say all the time, when you are dealing with IAS 16, there are other branch standards that you must understand with it. The first one is what we refer to as IAS 20, government grant. The second one is IAS 23, borrowing cost. The third one is IAS 12, income tax. Remember yesterday I explained to you the deferred tax when there is revaluation of assets. So IAS 12 is actually connected when you are dealing with property, plant, and equipment. And then the final thing that is connected with IAS 16, or the next one is IAS 40, that is investment property in relation to that. So that is also connected with this standard in that case. Then the final one is IAS 36, impairment of assets in that case in relation to that. Actually, there is also another one that we could connect, and that is IFRS 5, asset held for sale and discontinued operation. So actually, when you are learning about property, plant, and equipment, these other accounting standards are interconnected, and the examiner could ask you a question which relates to a property, plant, and equipment, but has a connection with any of these accounting standards. So either the company has revalued its assets and there is an upward revaluation and we are calculating the deferred tax on that, or whether the entity has borrowed money to acquire the asset or to construct the asset, that means that IAS 23 is going to come in borrowing cost, or the company bought the asset and receives a benefit from the government in the form of government grants, and so IAS 20, it's coming into the picture, or the business has been using the asset for day-to-day running, but now it is changing the usage of the assets to an investment property, and so then IAS 40 comes in, or an asset is being used as an investment property and now being changed for an administrative usage, and so you are changing from IAS 40 to IAS 16, property, plant, and equipment, or we are looking at a whole cash generating unit and we are assessing the impairment of the entire cash generating unit in relation to that. So when you are dealing with IAS 16, you don't just go on as a lone lion, you must go in the group like that, because all of these accounting standards are closely related to IAS 16, property, plant, and equipment. So let's get into it in relation to that. Now, when it comes to property, plant, and equipment, usually there are two uses that we have on them. When it comes to the property, plant, and equipment, a company can acquire a property, plant, and equipment and can be an owner-occupied asset. When we say an owner-occupied asset, it means that the asset is used by the company either as its administrative headquarters, or it's being used as a factory, all right, or it's being used as a showroom. Okay, so owner-occupied assets, these are assets used by what? The entity in the day-to-day running of the organization. Then we have other assets that the company owns or that the company controls. Let me use that word. And these are non-owner occupied assets. These are non-owner occupied assets. Now, to make it clear to us, I believe you know what is an asset. Assets are simply resources controlled by an entity as a result of past events from which the future economic benefit flows to the entity. So any resources that is controlled, so the asset shouldn't be owned, it should be controlled by the entity. That is why leases will come into the picture, IFRS 16, or when we outrightly buy the assets in relation to that. Now, so if a company controls the asset, but it is not using it as its headquarters, it is not using it as a factory, it is not using it as a showroom, or it is not even using it in its day-to-day running, but it is leasing it out to some people else, or renting it out to some people else, or it's having the assets and it's not doing anything on the asset, especially land, then that asset will be accounted for as what? An owner occupied, non-owner occupied asset in that case. Now, when the assets or property, plant, and equipment are owner occupied, that means that we will account for them in accordance with IAS 16, property, plant, and equipment. However, if the assets are controlled by the entity, but it is a non-owner occupied, in other words, it is not the entity that is occupying the asset, the entity is not using the property for its day-to-day running, then we account for that property under IAS 40 investment property. I hope you get a picture of the bet. So starting off, I want you to understand these two extremes. If the business is using the asset in the day-to-day running of the organization, in the day-to-day administration of the organization, we account for the assets in accordance with IAS 16, property, plant, and equipment. But if the company holds the asset, controls the asset, but it's not using the asset in the day-to-day running of the organization, in that case, we say that the assets should be accounted for in accordance with what? IAS 40 investment property. We are going to be starting with the IAS 16, certainly, because that's where we are going. If you joined the stream, you are welcome. I see some of you guys joining. Comment in the chat box with any questions that you have, and also give us a thumbs up on the video. That way it gets more engagement so we can reach many people as much as possible. That way YouTube will be able to push the video to reach as many people as possible. Then if you can also, you share the video on your WhatsApp platforms and your Facebook groups so that we will be able to get to as many people as possible watching the stream in relation to that. So let's come to IAS 16 now. Whatever accounting standard you take, among other things, there are three things you will be looking out for. The first one will be called the issue in relation to the initial recognition. Okay. The second one will be the subsequent measurement. And then the third one will be the disclosure requirements, or if you want, disclosures. So if you pick any accounting standard, almost any accounting standard, these three things must be there: the initial recognition, the subsequent measurement, and then the disclosure requirement. So when it comes to IAS 16, we're going to be trying as much as possible to go through these three things in relation to that. So let's start with the initial recognition. So when it comes to the initial recognition of property, plant, and equipment, what do we do? How do we go about it in relation to that? One thing you must understand is that in the initial recognition of property, plant, and equipment, we have to look at the issue in relation to the recognition criteria. So recognition criteria. Hi, Miriam, you are welcome. I see you. Today you decided not to be in the back scene. So thank you very much for joining the stream today as well. If there are any questions, please put them in the comment box or in the chat box. I'll be answering all of your questions for you. And I see some of you guys joining. Give us a thumbs up on the video and share the video as well, all right? So we get more people watching. So what is the recognition criteria for property, plant, and equipment? In a simple language, we say that to recognize property, plant, and equipment, there are a couple of things that must be present for us to recognize property, plant, and equipment. Okay, so Miriam said, thank you very much. You are welcome. So what is the recognition criteria? Let's go there. Number one, we say that the cost can be measured reliably. So the cost of the asset can be measured reliably. That's the first thing. Then at Kobana, okay, giving us a hi in the chat box. So can we measure the cost reliably? That's the first thing. The second thing is that the future economic benefit from the usage of the asset must flow to the entity, or will flow to the entity. Let's put it that way. So the future economic benefit or service potential in the asset will flow to the entity. So the cost can be measured reliably. Future economic benefit will flow to the entity in relation to that. And then the third thing that sometimes we can add is that it has to be a separately identified asset in relation to that. But usually we stick with the first two, that the economic benefits will flow to the entity and then the cost can be measured reliably, which simply means that the entity has a direct control over the asset. Remember, we said we will recognize the assets by finding out whether the entity controls the asset, because assets are resources controlled by the entity. So if these are the recognition criteria, how do we determine the initial cost of the property, plant, and equipment? The standard states that the initial cost of property, plant, and equipment shall be the purchases cost and any direct cost incurred in the acquisition of the asset, or any direct cost incurred in bringing the assets to its present use. So for pro forma purposes, if we want to look at any the issue in relation to the initial cost of the property, plant, and equipment, the standard states that number one, it should include the purchases price. How much did we buy it? That should be included. Then any other direct cost incurred in bringing the assets to its present location or condition must also be considered. Now, when we say any other cost incurred, we are talking about issues like maybe legal fees that we incurred in the acquisition of the asset. We are talking about issues like delivery cost, okay? We are talking about issues like installation cost, okay? And any other cost that we incurred in bringing the asset to its present use is considered in relation to that. Then, not only that we have to also look at the cost to dismantle or restore the land, okay? So cost of dismantling or restoration has to also be included. When we add these up, these are the things that we can talk about in relation to the initial cost. Please note this very well, that the cost of dismantling that we are bringing up here should always be the present value, okay? And so this is in accordance with IAS 37. So it is more or less like an environmental cost. So if the entity incurs an environmental cost in the, or the entity will incur an environmental cost in dismantling the assets, maybe it's a mining organization or an oil exploration company, then we will have to look at it in relation to how we can consider whether we will be incurring that cost in the future and how much that cost is, and we'll bring it to what? Present terms. So that present value is what we bring here. So when we add everything up, that gives us the initial cost of the asset. So IAS 16 states that the initial cost of the asset shall be what? The purchaser's price, they didn't bring the price, the purchaser's price and any other cost incurred in bringing the asset to its present use. That is what you have to understand about the initial cost. Now, once we get the initial cost like this, then the next thing we need to ask ourselves is, all right, what is the double entry for the initial cost? Now, this is where it's going to be very interesting. So I want you to stay with me carefully on this one. So if these are the initial costs, what is the initial double entry in relation to that? So the initial double entry, it's going to be simple. I want to chip it here so that we will be on the same page. We're going to be debiting certainly the property, plant, and equipment with the initial cost value we had, and we'll be crediting either cash or provisions. Be careful here. We will credit either cash or provisions. Now, why is provision coming in? Provision will come in about this particular cost of dismantling or restoration. Okay, the cost of dismantling or this restoration, it's what will create the provision. Remember, I told you that if, for instance, the place will be restored in 20 years' time, and the cost of capital of the company is 15%, we find the annuity factor of that, and then we will discount it to the present value in relation to that. That present value figure, we debit the property, plant, and equipment with it, and then what? We credit the provision account in relation to that. I will explain that as well much better when we are looking at IAS 37 later on in the discussion in relation to that. But this is what constitutes the initial cost of the asset, the purchaser's price and any other direct cost incurred in bringing the assets to its present location and what condition, or making the asset ready for use. Then the cost of restoration, the cost of dismantling is also something that is considered. But please note that the cost of restoration and the cost of dismantling is always the present value of the money we are going to be paying in the future, and that is in accordance with IAS 37. Any questions? I see a lot of you guys joining. Comment in the chat box if you have any questions. And if you have not given us a thumbs up on the video, come on now, hit the thumbs up, and then that way the video gets more engagement and YouTube will be able to push it to others so others can watch, so we can reach as many people as possible. So give us a thumbs up on the video as we continue with the discussion. And if you have any questions, don't hesitate, put it in the chat box so that as I go on, I'm reading your comments and I'll be answering them live like that as we continue in that case. So that is the initial recognition. So we are done with the first part. This is where it will be interesting. Subsequent measurement. So after the initial recognition of the asset, what is the subsequent measurement? How will we account for the assets? How do we account for the assets in our books? Now remember, I'm not going to be talking about the provision aspect here because there's a subsequent measurement for that, where I will talk about that when we are doing IAS 37, but I just want to give you some view about that. The subsequent measurement of that provision is that we find the unwinding. So with the unwinding, we use the cost of capital of the company to multiply the present value. The figure we get, we'll debit the income statement and we'll credit the provision account in relation to that. So that will be done every year. But like I said, we'll be looking at that under IAS 37. But let's go to the subsequent measurement under IAS 16 here. So subsequent measurement. So after the initial recognition, the standard states that on subsequent measurement, that is after the acquisition of the asset, the entity can use any of these modules to account for the asset. So there are two key modules that we're going to be looking at. We have what is called the cost module and then the revaluation module. So the cost module and then the revaluation module. Now the cost module simply is the initial way that assets are accounted for. So with the cost module, what happens is that the carrying value of the asset will be equal to the cost of the asset minus any accumulated depreciation. So that is the cost module. It means that the asset is carried at its historical cost. It's carried at the price at which we bought it in relation to that. So that is a cost module, and we say that the carrying value is the cost minus the accumulated depreciation. I see a comment from Uche Ijehu. She said, the Zoom ID and password. Uche, this is not a Zoom session that I allow people to come in. I'm just using Zoom to do the broadcast on the YouTube channel. So you just have to stay here with me on YouTube, and then whatever comments or questions you have, you can put them in the chat box for me. Okay, Uche, today it's not open YouTube session. It's a closed YouTube session, actually. I'm using it to be able to stream to YouTube in that case. So Uche, sorry about that. But whatever questions you have, put it in the chat box. I'm reading all of your comments and I'll be answering them in real time like that. So that is the cost module. Then we come to the second one, that is the revaluation module. Under the revaluation module, again, we say that the carrying value, so let me divide this, the carrying value equals the fair value minus accumulated depreciation. We could add impairment here. Now, okay, so Uche said, oh, okay, all right. Now with the revaluation module, this is where the asset is carried at its fair value. Okay, so the cost module is where the asset is carried at its historical value, or we use the historical cost, but the fair revaluation module is where the asset is carried at its fair value. Now, when we say the fair value of an asset, what do we mean? The fair value simply is the value at which an asset can be exchanged or a liability can be settled in an arm's length transaction between knowledgeable parties. Okay, the amount at which an asset can be exchanged or a liability settled between two parties in an arm's length transaction, right? Now, when we talk about fair value under property, plant, and equipment, we simply mean, in a simple language, we are simply talking about the current market value. In other words, if I'm buying that property today, how much is it? How much is it worth? That is what we mean by the fair value. Now, even though there are these two modules that can be used by the entity, that is the cost module and the revaluation module, the standard states that at least once a year, an entity must revalue its assets. Does it make sense? So even though the entity can use either the cost module or the revaluation module, the standard states that at least once a year, the entity must revalue its assets. But this is what you have to understand. It is not all assets that we can determine their fair value, because to be able to use the revaluation module, it means that the asset must have a current market. All right, so there should be a ready market where we can easily price the asset or get somebody to buy the asset or get someone to value the asset. So if the asset is easily tradable, then we can use the revaluation module. But there are some assets that don't have fair market value. In those assets may be customized assets just by the company. So in that case, the company will still stick to what? The cost module in relation to that, because we cannot revalue the asset because it is not an asset that can be used by another person or that can be traded on the market. But if there is a ready market available for the asset, the standard says that we must at least revalue it once a year. Where there is no ready market available, then what do? We stick with the cost module in relation to that. So these are the two modules available that an entity can use in the determination of the subsequent measurement of the asset. Now, like you can see, whether you are at the cost module or the revaluation module, one thing stands out, and that is what? Depreciation. So you realize that depreciation is everywhere. Whether we are using the cost module or the revaluation module, there is depreciation somewhere. So let's deal with depreciation, and let's look at how we can account for depreciation as well in relation to that. Now, you know that traditionally we have the straight line method, the reducing balance method, the sum of the years they get method. All those methods are there in relation to that. So subsequent measurement, we can use the cost module, we can use the revaluation module. Remember, even though these two modules are available, the standard requires that at least once a year, the entity revalues its assets. However, the revaluation will be done only when there is a ready market available for that asset. But if the asset has no ready market from which we can determine the fair value, then the entity can stick with the cost module in the subsequent measurement of the asset. So let's look at the issue in relation to depreciation. Then we'll look at the double entry that the depreciation is going to be coming up with in relation to that. Any questions, you put it in the chat box for me, okay? So I can answer them in real time. Right, so let's look at depreciation. So let's look at the issue in relation to depreciation. Now, in a simple language, we say that depreciation is the allocation of the cost of the asset over its economic useful life, or the written down value of the asset during the year under consideration. So when it comes to depreciation, like I mentioned, there are a couple of methods, but we're going to be sticking to two key methods. That is the straight line method, and then the reducing balance method. Now, stay with me with the distinction clearly. Now, when it comes to the straight line method, what happens is that, number one, depreciation is computed on the cost of the assets. Very important. Depreciation is calculated on the cost of the assets. So we calculate the depreciation on the cost of the asset. Hi, Ignatius Entry, I see you. You're welcome. Give us a thumbs up on the video if you have not, so it gets more engagement. Depreciation is calculated on the cost of the asset. What does that mean? It means that if in the exam more we are told that depreciation is 20% straight line, what do? It means that depreciation is going to be 20% of the cost of the asset. That is what we mean by depreciation is charged on the cost of the assets. I hope you get the principle there. Number two, when we are doing straight line method, it means that the same amount of depreciation is charged over the economic useful life of the asset. Okay, so same amount of depreciation is charged. Depreciation is charged over the economic useful life of the asset. So the same amount of depreciation will be charged over the useful life of the asset if we are using the straight line method in relation to that. Now, there are other times the examiner may not give us the percentage. but he will give us the economic useful life of the asset. In that case, we say that our annual depreciation will be equal to the cost of the asset minus the scrap value or the residual value divided by the economic useful life. So the cost of the asset minus the scrap value or the residual value divided by the economic useful life of the assets in relation to that. So with the straight line method, all I want you to understand is this, that the depreciation is calculated on the cost of the asset and the same amount of depreciation is charged over the economic useful life of the assets. Now, when it comes to the reducing balance, what happens here is that depreciation is calculated on the carrying amount of the asset. Depreciation is calculated on the carrying amount of the asset. So depreciation is calculated on the carrying amount or the carrying value of the asset. So that is the reducing balance method. So unlike the straight line where depreciation is calculated on the cost of the asset, with the reducing balance method, depreciation is calculated on the what? Carrying value or the carrying amount of the asset. For that reason, under the reducing balance method, we say that the depreciation charge reduces as the asset ages. Okay, depreciation charge reduces as the asset ages. In other words, as the asset increases, the longer we use the asset, the less amount of depreciation is charged. It means higher depreciation is charged at the early stage of the asset and lower depreciation is charged as the asset ages. And this makes a lot of sense because when you buy a new asset, it is more productive. You may use it for maybe 20 hours straight without breaking down. But as the asset ages, you realize that initially you could use it 20 hours straight, but now you can use it maybe 3 hours straight or 4 hours straight. So the reducing balance method really gives us that the accuracy in terms of the computation of the depreciation of the assets in relation to that. However, there are some properties also that don't experience that decline in productivity. They remain the same, like building, all right? That is why normally building, we use the straight line method for them in relation to that. And then things like things like plants and equipment, we normally use the reducing balance for them because as they work and as they age, the depreciation charge reduces in relation to that. So in a simple language, when it comes to the reducing balance method, we say that the depreciation will be equal to whatever percent that is given to us. So let's say they give us 20% here also. It's going to be 20% multiplied by the carrying value of the asset or the carrying amount of the asset. And that is how we deal with the depreciation under the straight line method, under the reducing balance method, respectively. Any questions? Put it in the chat box for me. Any questions? Put it in the chat box for me. I believe we are all following so far. Now, so what is the double entry? Okay, so what is the double entry? So we've computed depreciation maybe under the straight line method or under the reducing balance method. What is the double entry? In a nutshell, what's the double entry? The double entry is simple. We debit the income statement and then we credit property, plant, and equipment. Simple. We debit the income statement and then credit property, plant, and equipment. So that'll be the double entry for our annual depreciation charges. So still on the subsequent measurement, isn't it? So we debit the income statement with the depreciation charge, and then we credit property, plant, and equipment. Now, when we say credit property, plant, and equipment, it simply means what? You subtract it. Remember in the initial recognition, when you bought the asset, you debit property, plant, and equipment. So now when you charge the annual depreciation, what do? You credit the property, plant, and equipment to get the carrying amount or the carrying value, which you will take to the statement of financial position. You are debiting the income statement because annual depreciation charge is an expenses, and that must be accounted for in the income statement for the organization in relation to that. So either we using the straight line method or we are using the reducing balance method. Like I mentioned, there is also the sum of the years, decades there that could also be used, but these are the two that we are more going to be seeing in the exam hall in relation to that. So having spoken about the depreciation, one of the key things that is still under the subsequent measurement that we need to talk about has to do with revaluation of assets. Because remember, I told you that the standard says that, or the standard states that at least once a year, an entity must revalue its assets. So if at least once a year, an entity must revalue its assets, then what do we do? And how do we do that revaluation? And if the revaluation actually occurs, how do we account for it? And this is where I want you to make sure you understand me very carefully, because you might have get everything that we have done so far, but if you don't pay attention to the revaluation, because it has a way of how it is done, and many students actually struggle with that. And so make sure you follow me and get an understanding in relation to that. So let's go to revaluation of assets. Now, so when it comes to revaluation of assets, what do we mean? Like I told you earlier, the standard requires that at least once a year, we revalue our assets to find out what's happening to the asset, to find out whether it's good or it's bad, or whether the value has increased or the value has reduced, so that we can bring the financial statement can represent a true and fair view of the entity. But remember, we said we can only revalue the assets if there is an active market for the trading of such assets. So when it comes to revaluation of the birds, two things must be in your mind. There is what is called the upward revaluation, and then the downward revaluation. Let's take that again. Upward and then downward. So there's an upward revaluation, downward revaluation. This is where I want you to make sure you pay close attention, all right? Close attention, stay focused. When we say upward revaluation, what do we mean? Now, there is what is called the initial revaluation. So let's say we bought the asset last year, and this year we revalue the asset. So the initial revaluation of the assets. Okay, so I see a question from Collins. Let me see. Please, sir, don't forget to explain how to depreciate the component of assets, example, aircraft. Okay, I'll be doing that. Don't worry. Maybe after this, not maybe, after this, I'll talk about that. That's one of the questions I usually get in relation. Okay. Now, so what is upward revaluation? So the first time we revalue the assets, there is upward revaluation. So there is an upward revaluation when the fair value of the asset is greater than the carrying value of the assets. So in our books as a company, we have depreciated the asset, and the carrying amount of the asset is, say, 2,500. But when we go to the market now, we realize that the asset is selling for, let's say, 32,000. So that means there is an upward revaluation. That upward revaluation results into what is called revaluation surplus or revaluation gain. So this 7,000 I'm going to be getting here, it's going to be revaluation surplus or revaluation gain. Now, when there is a revaluation surplus or revaluation gain, what is the double entry? This is what I want you to make sure you stay with me carefully. The double entry is simple. We're going to be debiting the property, plant, and equipment with the revaluation surplus or gain, and then we credit the revaluation surplus account. Please note, in addition to crediting the revaluation surplus account, the revaluation gain also goes to the OCI, the other comprehensive income. Remember, this is a first-time revaluation and it's an upward revaluation in relation to that. So a revaluation surplus comes in when the fair value of the asset is greater than what? The carrying value of the asset. So this 7,000 you see here, the double entry is that we debit property, plant, and equipment, and then we'll credit the revaluation surplus. But remember, for the income statement and other comprehensive income for that year, the revaluation surplus will come to the OCI segment of the financial statement as part of the receipts in relation to that. And that will be an addition in the OCI for that organization. Remember, it is that revaluation gain that I said we could compute a deferred tax on it, and that will also come in the other comprehensive income, what we discussed yesterday under IAS 12. But it doesn't end here. You see, when there is a revaluation gain or when there is a revaluation of assets like this, the standard states something again. The standard states that depreciation should be computed on the revaluation amount, on the revalued amount. Depreciation should be calculated on the revalued amount. That is what the standard has said. What does that mean? It means that subsequent to the revaluation, now we will depreciate the asset not using the carrying value of 25,000 that I have here, for instance, but we will now depreciate the asset using the 32,000, the revalued amount. Now, what is going to be happening? Bernard Kobiner said OCI, yes please, OCI, other comprehensive income. The revaluation surplus goes to other comprehensive income. So since the depreciation figure is now going to be, or depreciation is now going to be calculated on the revalued amount, what is going to be happening? What is going to be happening is that now the depreciation that we are going to be charging will be higher than what we have to charge. For that reason, when depreciation goes up, what happens to profit? Profit reduces. When profit reduces, what happens to the shareholders? It means less profit is available to be paid to them as what? Dividends. So in order to compensate the shareholders, there are times where the company will do what is called an annual transfer. So the annual transfer is where the revaluation surplus that we have had is transferred from the revaluation surplus to the retained earnings to compensate the shareholders for the increase in depreciation that the revaluation has caused. So what does that mean? It means that our annual transfer will be equal to the revaluation surplus or gain divided by the remaining useful life of the asset. The remaining economic useful life of the asset. Please stay with me carefully on this one. Okay, John Edu is saying, even if straight line method, yes, once the asset is revalued and there is a revaluation gain, and it's the first time that we are having a revaluation gain like that, it still has to go to the OCI. Okay, because remember I said we could be using straight line method, but the assets can be revalued. So once we are doing the revalue or revaluation, the gain must go to the OCI. Then John is saying depreciation is still on fair value. Yeah, depreciation will now be calculated. After the revaluation, the depreciation will now be calculated on the revalued amount. So like in my illustration here, my revalued amount is 32,000. So instead of calculating the depreciation on the 25,000, I did 2,500. Can you imagine that? On the 25,000, I will now be computing it on the 32,000 in relation to that. John, are you okay? All right. So we do the annual transfer to compensate the shareholder. Now, please note, it is not all the time that this annual transfer is done. There are times the examiner will tell you no transfer is made as a result of the excess depreciation. There are times the examiner will tell you the transfer has to be made as a result of the depreciation. So listen to the question carefully or read the question carefully before you make this decision. Okay, Richard AJ said, please, can you explain the annual transfer again? All right. The annual transfer is coming in. Okay, John Edu said, yes, sir. Okay, you're good. The annual transfer is coming in because the standard states that depreciation should be calculated on the revalued amount. So instead of computing the depreciation on my 25,000, the carrying value of the asset, or maybe the cost of the asset, we are going to be now computing depreciation on the 32,000, the fair value of the asset. For that reason, more depreciation will be charged. And since more depreciation is being charged, what happens is that profit is going to reduce. When profit reduces, it means less profit will be available to be paid to the shareholders in relation to that. For that reason, the entity may adopt, the standard states that the entity may adopt to make an annual transfer from the revaluation surplus to retained earnings to compensate the shareholders for the fall in the profit as a result of the excess depreciation due to the revaluation of the assets. Does it make sense? So the calculation of that annual transfer is the revaluation surplus or the revaluation gain that we had from our computation here, maybe $7,000. Then we divide that by the remaining useful life of the asset, the remaining useful life. There are times when an entity revalue the asset, they may also change the remaining useful life of the asset. If they do, the new remaining useful life is what we are going to be using here. If they don't, then we will just deduct and do our workings, and then we will find out the remaining useful life. And that is how we do the annual transfer in relation to that. So Richard, okay, Richard said he's okay now. So when we now get the value for the annual transfer, what is the double entry? Because remember, this is only happening in the statement of changes in equity. The annual transfer doesn't affect the income statement. The annual transfer occurs in the statement of changes in equity. For that reason, we're going to be debiting the retained earnings with the annual transfer we had. Did I say debit retained earnings? Sorry. We debit revaluation surplus, and then we credit retained earnings. Now, when I say debit revaluation surplus, it simply means we deduct it from revaluation surplus, and then we add it to the retained earnings in the statement of changes in equity. Does it make sense? So this is how we deal with the annual transfer. Remember, I said it is not all the time that this is done. It is only done when the entity has adopted to do so, or when in the question the examiner says we should do that. Then we will say that we will do this annual transfer in relation to that. But this is one thing you have to also note. Revaluation can be done either at the beginning of the year or at the end of the year. Please don't mix this one. Get this one carefully. Revaluation can be done at the beginning of the year or at the end of the year. Listen to me carefully. If revaluation is done at the beginning of the year or any time before the year end, then when there is a revaluation surplus and the entity makes an annual transfer, they will make the annual transfer for that year. Let me take that again. Assuming the entity revalue the asset at the beginning of the current accounting year, then depreciation will be calculated using the revalued amount at the beginning of the year. For that reason, we will do an annual transfer for that year. However, if the entity makes the revaluation or revalue the assets at the end of the year, it means depreciation for that year had already been calculated. So we will not do any annual transfer. We will only recognize the revaluation surplus in the OCI, in the statement of changes in equity, and ultimately taking it to the statement of financial position. I hope you get that statement very well. So when we do the revaluation at the beginning of the year or any time before the year end, and the entity does an annual transfer or makes an annual transfer, we will do it. But if the revaluation is done at the end of the year, and even the question says the company does annual transfer, you don't do it, because since the revaluation was done at the end of the year, depreciation had already been calculated for that year. So it is the subsequent period that the annual transfer will start. I see a comment from Richard AJ. Please indicate in the comment box, let me know you understand. Please, what if the question is silence on the annual transfer? Good. If the question is silence on the annual transfer, you can make the annual transfer. Because traditionally, like organically, when the examiner is silent on the transfer, you can make the transfer in relation to that. But where the examiner doesn't want you to do the transfer, he will state that the entity doesn't make transfer from the revaluation surplus to the retained earnings as a result of the excess depreciation. So where it is silent, it means we need to make the annual transfer in relation to that. So Richard, I believe you are okay. And I believe everybody is okay so far. If you're watching, you have any questions, please put it in the chat box. I'm reading your comments live, and I'll be answering all of your comments as well. And do well to give me a thumbs up on the video. That way it gets more engagement, and YouTube will be able to push the video to reach as many people as possible on the platform there. And also do well to share the video with your friends, colleagues, and loved ones, people you think they must be watching this video right now, or they must join the stream right now. Share it with them on your WhatsApp, your Facebook groups, so that we will be able to reach many people as well in relation to that. Okay, so everybody okay with the revaluation upward? This is one of the challenging areas, so make sure you understand it very well, all right? Make sure you understand it very well. So what is the takeaway here? Number one, when there is a revaluation upward, there is going to be a revaluation surplus or revaluation gain. The double entry is to debit property, plant, and equipment, credit revaluation surplus, and the other comprehensive income. Note, the standard states that after revaluation, depreciation must be calculated or is calculated on the revalued amount. For that reason, the entity may adopt to make an annual transfer from the revaluation surplus to the retained earnings as a result of the excess depreciation coming in due to the revaluation of the assets. And that annual transfer is only effected in the statement of changes in equity by debiting the revaluation surplus and crediting the retained earnings in relation to that. Okay, so Collins giving us a thumbs up in the chat box. So this is what we have to talk about in relation to the upward revaluation. Now let's look at the second part, downward revaluation. And I want you to pay close attention here because it's going to be very critical. Bernard said, can you please go over the latter part of your presentation? Okay, Bernard, if you say latter part, are you talking about the annual transfer? Is that what you're talking about, Bernard? Okay, so if you're talking about the annual transfer, we say that, or I said that because there is the standard states that we should compute depreciation on the revalued amount, okay, on the revalued amount, the depreciation figure for that year is going to go up So if the depreciation figure for that year is going to go up, it means that the profit for that year is going to reduce. So if the profit for that year is going to be reducing, then what we are going to be doing as an organization, as an entity, is to compensate the shareholders. How do we compensate them? We compensate the shareholders by making an annual transfer from the revaluation surplus to retained earnings so that there will be more profit available, out of which we will be paying the dividend. And how do we do that? We say that the annual transfer is equal to the revaluation surplus divided by the remaining economic useful life of the asset. Remaining economic useful life of the asset. And the double entry is we debit the revaluation surplus and credit the retained earnings in relation to that. Bernard said, you said revaluation can be at the beginning or at the end. Oh, okay. So that is what you're talking about. Yes. So I said the entity can revalue assets at the beginning of the year, during the year, or maybe at the end of the year in relation to that. So if the entity revalue the assets at the beginning of the year, it means for that year, depreciation will be calculated on the revalued amount. For that reason, if the entity adopts to make an annual transfer, they will make the annual transfer for that year. Are you following the concept? We'll make the annual transfer for that year. But where the entity makes the revaluation at the end of the year, then depreciation had already been computed. So even though there is a revaluation surplus, we will not make an annual transfer for the year just ended. Okay, for the year just ended in relation to that. But the transfer will start in the subsequent year. So Bernard, are you okay now with the explanation on at the start of the year and at the end of the year? Isaac Besimana said, good, all right. Ebenezer Atta said, my internet went off. Okay, sorry about that. Damilari said, is there something called write back? Is that the same as an annual transfer? I've not really heard the word write back before, but if it is in the context of the excess depreciation that is being charged, then the annual transfer could be the same as the write back. But the truth is, I've not really heard that word. Maybe I might have heard, but I don't remember really about it. Okay, Bernard said, thank you. So Damilari, I don't know about the write back, but if it is in the context of the revaluation or the excess depreciation, then the annual transfer can be the write back in relation to that, because the context of write back works best where there is a revaluation loss in the subsequent year after there is a revaluation gain in the previous year, which is where I am coming to under the second aspect when there is a downward revaluation. Okay, so Bernard Corbiner said, yes, sir. All right, so you are good. Okay, so let's look at the second aspect. Everybody okay? Any other questions we have for me? Okay, so let's go to the downward revaluation. So everything we've spoken about here is about the upward revaluation, right? So let's go to the downward revaluation. Then I will now handle Colin's question on the compound assets or aircraft, how we depreciate them. So let's go to downward revaluation. Now, there is another trick here that I want you to make sure you pick. So stay with me very well on this, okay? Stay with me very well on this. So downward revaluation. downward revaluation. I don't know, my touchpad is just misbehaving now. Okay. So downward revaluation. Like I said, there is a trick here, so make sure you get me well. When it comes to downward revaluation, there are two things you're going to be understanding. There is what I call the first time downward revaluation of an asset, but before even I come there, let me explain this. When you talk about downward revaluation, there is a downward revaluation when the fair value of the asset is less than the carrying value of the asset. So when the fair value of the asset is less than the carrying value of the asset, that leads to what is called the revaluation loss, or sometimes we call it impairment. So we are accounting for the assets, and then in our books, we say that the carrying value is say $3,000. But when we go to the market, that same asset is trading for just $1,700. So if you check, we are having a loss of $1,300 in relation to that. That is a revaluation loss, or that is an impairment. But when it comes to revaluation loss, there are two things you need to understand. That is what I mentioned earlier. We can have a revaluation loss from a previously upward revalued asset. What does that mean? So let me give you some illustrations real quick so that I explain this principle for you well. So previously, we revalued the asset and there was an upward revaluation. Then 1 year after or 2 years after, we revalue the asset again and there is a revaluation loss. How do we account for it? Now, for that first aspect we are looking at, when there is that revaluation loss, you don't just go to the income statement and take it to the income statement. The revaluation loss must be written off against any revaluation gain outstanding at the date of the revaluation in relation to that. So previously, the asset has a revaluation. We revalue the asset, there was an upward revaluation, and it had a gain or a surplus. Then subsequent, now we are getting a loss. Traditionally, if there is a revaluation loss, we are supposed to debit the income statement and debit the property, plant, and equipment. But you don't just get up and debit the income statement because the asset already has some gain. So you write the loss against the gain in relation to that. I believe you get that principle. So let me give you a couple of tips or illustrative thing in relation to that. So let's say year one. I'm going to assume a very simple scenario here. Okay? So let's say the carrying value of the asset is say $3,000, and there is a fair value, and that is going to be, let's just say, 6,500. And let's say that the remaining useful life, it's say, let's keep it simple as 10 years. All right. So this is the year one. We revalue the asset usually at the beginning of the year. So I'm assuming that we are doing the revaluation at the beginning of the year. Okay. So there is a revaluation surplus, and that is going to be the 6,500 minus the 3,000, and that's going to be 3,500. I'm assuming that there is no annual transfer here. So this revaluation surplus, we debit the property, plant, and equipment, and then we'll credit what? The OCI, other comprehensive income. So the depreciation for that year will be calculated, and that will be 6,500 divided by 10, and that will be 650. So the carrying value of the asset at the end of year one is going to be 6,500 minus 650, and that should give us 6,500 minus 650. That should give us 5,850. So at the end of year one, this is the value of the asset. Then let's say that at the beginning of year 2, there was a revaluation again. And now the fair value of the assets is just somewhere around $3,200. So follow me carefully. So what are we seeing here? There is a downward revaluation. So we see that here there is going to be a revaluation loss of the carrying amount minus the fair value, which is the 5850 minus the 3,200, and that's going to give us 3,200. That's going to give us 2650. Are we following? Good. So this is the revaluation loss. Now, assuming this was the first time, or the year 2 was the first time we revalued the asset and we had this loss, we wouldn't have thought about anything. All we would do is that we would debit the property, and we would debit the income statement. That's all, and then we'll credit PPE. No cause for alarm. But remember, this asset that is having a loss of 2650 in the second year had a revaluation gain in year 1 of 3,500. So the loss must be written off against the revaluation gain. So what do? The double entry of this revaluation loss will be that, now if you check, the revaluation loss has 3,500, which is more than the loss we are getting. So we write the loss against the revaluation surplus. So what do? We debit the revaluation surplus with the 2650, okay? And then we credit property, plant, and equipment with that same figure, 2650. So instead of debiting the income statement, we will debit what? The revaluation surplus. So that now, at the end of the year 2, now the revaluation surplus account is going to have 3,500 minus 2650, and that's going to be 850 in relation to that. This is what we mean by revaluation downward when the asset previously has a surplus. So like I said, assuming the year 2 was the first time we are revaluing the asset and there is this loss, it's an impairment of the asset. So in a simple language, we will debit the property, plant, and equipment, then we'll credit the PPE. But when the asset that is now having a downward revaluation was previously having a revaluation surplus, then the loss will be written off against the gain that we had recognized previously. So assuming in this case, the loss is not enough to cover for all the gain that previously we recognized, then the excess is what will be taken to the income statement. I hope it makes sense now. So we debit the property, plant, and equipment. Sorry, we debit the revaluation surplus, we credit the PPE, then any excess will be taken to the income statement in relation to that. Any questions on this, or everybody okay? Indicate in the chat box. Let me know if you are okay or you have any questions for me. Everybody good? All right. Uche said she's good. Colin said 6,500 minus 650, re-explain. Okay. Bernard said, well understood. Now, Collins, the 6,500 minus 650, the 650 is the depreciation because the remaining useful life of the asset is 10 years. So 6,500 divided by 10 will give us 650. And the revalued amount is 6,500. So we take the 650 from the 6,500, and that gives us the carrying value at the end of the first year that is 5850. So Collins, I hope you understand that now. Then Richard J said, please, when there is a revaluation loss for the first time, how do we account for it? Yeah, Richard J, for the first time, that is why I said we will take it straight up to the income statement. Okay, we take it straight up to the income statement. So if there is a first time and there is a revaluation loss, it's an impairment of the asset. And so for that reason, we just take it, we debit the income statement and we credit the property, plant and equipment. So Emmanuel, Richard AJ, I hope you understand now. Then Tony said, so let's say in the third year and there is another revaluation loss, will it be written off against the remainder of the revaluation gain? Yes, Tony, excellent. It will be written off against this 850. So if in the third year, the loss is more than the 850, then the balance, the remaining figure, will now be taken to the income statement. So you will only go to the income statement if there is no loss on the asset. That's the idea. So if there is no previously identified or there is no previously revaluation gain on the asset, then you go straight and debit the income statement. But if the asset has any gain, then you have to come back and come and write it off against that gain. Then if it cannot cover all the gain, then the excess is what will be taken to the income statement in relation to that. Okay, Tony. So John Edu, okay, so John is actually explaining. Yeah, Collins, he said 650 straight line. Yes, 650 straight line. I think John and Bernard has also explained, type that for you out. So it's the 6,500 divided by 10, giving us 650. So Collins, I believe you are okay. Right. So when it comes to IAS 16, we've spoken about what? The initial recognition, the criteria. We've spoken about what constitutes the initial cost of the asset. We've discussed the issue in relation to the subsequent measurement. We said you can use the straight line method, the reducing balance method, sorry, the cost module, and then the revaluation module. Then we said depreciation is going to be coming on the assets in relation to that. And the depreciation, we can use the straight line method or the reducing balance method. Then I said, okay, the standard states that even though the entity has the option to use these two methods, at least once every year, the assets must be revalued. So when an asset is revalued, then the depreciation will now be computed on the revalued amount. And that is why we say we have upward revaluation and downward revaluation. And I have used this illustration to explain the downward revaluation to you in relation to that. So Colin said, right on, sir. All right. Richard AJ also said, thanks, sir. Okay, that's well. That's fine. Now, so what we've discussed so far is a single asset. So let's go to Colin's comments when, like, for instance, an aircraft, how do we depreciate such assets in relation to that? When it comes to compound assets in that case, the way we account for them will be dependent on the components of those assets. So let's take, for instance, an aircraft. I think that was what especially Collins spoke about. So we have to know the parts, the major parts of the aircraft. And usually we use the straight line method here. So it means that the component parts of the assets will be depreciated differently. Okay, the component parts will be depreciated differently in relation to that. So let's see, for instance, an aircraft. There are some major parts of the aircraft that we need to understand. We have what is called the wings. We have the fuselage. We have the landing gear. So we have the wings. We have the landing gear or gear, depending on the school you attended. and the teacher who taught you how to pronounce things. Then we have the power plant in the front. Let me see if I can have, then we have the fuselage between the tail and then the card body or so, something like that. Fuselage. So let's just say these are the parts. Okay, there are about 6 major parts, but let's stay with it. So what it means is that, yes, the total aircraft, maybe let's say it costs how much? $30 million. We're going to be depreciating. Then the engine has not really come. I don't know if the engine is part of the power plant area, but they could come. So let's say we bought the aircraft for, say, $30 million. One of the Gulfstream used, something like that. So $30 million. So the entity will depreciate each component differently. Okay. Now, the wings may be depreciated over a period of, say, 10 years. The landing gear, because when it takes off, it lands. When it takes off, it lands. That one may be depreciated over probably something like maybe 4 years or 5 years. Then the power plant, that is the engine, because of the mileage, that one we're going to be using the mileage to be able to, so when it comes to the depreciation, a lot of indicators will be used. So here we don't really use the years. So the engine, for instance, we're going to be looking at the mileage. So if the total mileage of the engine is whatever, 10,000 or 20,000 miles or whatever it is, then for every nautical mile that the plane flies, we are going to be calculating the rate of depreciation, and then we account for it in relation to that. So the total plant or the total aircraft is $30 million. It may be allocated that the wings maybe cost $5 million. The landing gear maybe cost $2 million. Maybe the power plant maybe cost whatever, $8 million. The fuselage maybe costs something like $3 million. Then the cabin, like the lounge area, okay. So the main sitting area of the aircraft may cost something like the rest of the amount. Let's see, 5, this is 10, 18. So let's say this is $12 million. So the depreciation will be computed based on whatever method or way that we're going to be depreciating it in relation to that. So there are some we are going to be using years. There are some we are going to be using the mileage on them in relation to that. Something like the landing gear, something like the engine, something like the power plant. We're going to be accounting for them or depreciating them using the numbers that are on them in relation to that. So when it comes to compound assets like an aircraft, that is how the depreciation will be done. So the total amount will be allocated on the major parts, and then different measures of depreciation will be used to calculate the depreciation figure for each of them in relation to that. So Collins, I believe you understand the concept now, because this was a question that you asked in particular. Any other questions for me, please? Any other questions? Okay, so these are the things you need to understand about assets in relation to that. So the final aspect is the disclosure of IAS under IAS 16. So when it comes to property, plant, and equipment, what do we disclose about it? Like, what do we disclose about it? Among other things, we need to disclose the assets that were acquired during the year. We have to disclose the cost of the asset. And then we have to also look at the economic useful life of the asset. It must be disclosed. we need to also discuss the issue in relation to the methods of depreciation that we are using. Then we have to also state how the assets was acquired, whether it was acquired through an outright acquisition or whether it was through lease, and how long have we leased the assets. All of those things must be listed about the assets in relation to that. So when it comes to IAS 16, these are what you must understand in relation to IAS 16, property, plant, and equipment. Okay. Property, plant, and equipment, right. So that is all about IAS 16 in relation to that. So let's go into IAS 36, impairment of assets. Actually, to be able to do IAS 36, I need to do it in line with the brother of IAS 36, and that is IAS 38. So let's do these two together, IAS 36, IAS 38. If you watch my video on the standards, I always do these two together because of their relationship. So IAS 38 is intangible assets, and then IAS 36 is impairment of assets. The reason why I do them together all the time is that when you are doing the IAS 38, impairment will bring itself up as you continue with the explanation in relation to that. So please, if you have any questions, please don't hesitate, put it in the chat box. And if you are watching and you have not given us a thumbs up on the video, come on, hit the thumbs up button on the main page of the video. That way it gets more engagement and YouTube will be able to push the video to others to watch. And if you have not subscribed to the channel also, make sure you hit on the subscription button and the notification bell icon so that anytime I go live or I release new lecture videos, you'll be the first person to be notified as a VIP member of the group as well. So intangible assets, what are intangible assets? So we say that intangible assets are resources, or we can put it this way about intangible assets. We say that these are resources. Okay, I see a comment. Let me look at that real quick before I go. Is it true that revaluation surplus never goes to zero? And if yes, why will you send the excess of the revaluation loss to the income statement? Is it true that the revaluation surplus never goes zero? No, the revaluation surplus may go to zero depending on the asset we are dealing with. So once we are dealing with an asset whose surplus or whose loss outweighs the surplus, then the balancing figure will definitely has to go to the income statement. So Richard AJ, the revaluation surplus may go to zero. If the loss we are having is more than the surplus, then certainly it will be nil, and then the excess would have to be taken to the income statement. Because the concept is that revaluation surplus or revaluation loss is actually an impairment, and an impairment is supposed to be taken to the income statement. But the reason why we won't take it directly to the income statement is because previously the asset is having a profit, okay, or the asset is having a gain, a revaluation gain. For that reason, the loss, instead of taking it directly to the income statement, we write it off against the loss, and then the excess is what goes to the income statement in relation to that. So, Richard AJ, do you understand? Let me know if you get, if I have answered your question for you. Okay. So let's go back. Intangible assets. Gota Caleb. All right, see the thumbs up in the chat. Thank you very much. And Give us a thumbs up on the main video page as well. Thank you. So what are intangible assets? We see that intangible assets are simply resources with no physical substance, but have value to the business. Okay, so resources with no physical substance, but have some value to the business can be referred to as what? Intangible assets. So example of intangible assets, we can talk about what? Patent, copyright, goodwill, patent, copyright, goodwill, R&D, research and development. I see a comment. Let me look at that. How do you treat revaluation surplus or loss when building is revalued upward and plant is revalued downward? You treat them separately the way they are supposed to be treated. So Collins, you treat them the way they are supposed to be treated. The gain for the building will be recognized in the other comprehensive income. And then the profit or the loss on the plant will be taken to the income statement in relation to that. So you account for them separately in that case because they are not in the same class of assets, all right? Building may be account for differently to the plant. So the plant is not having a gain previously. So we would just account for it as a normal loss and then account for it in relation to that. Then the gain will be recognized in the other comprehensive income. So Collins, I believe you understand. Said sorry for taking us back. Don't worry. So intangible assets are resources of no physical substance, but which have some value to the entity. So patent, goodwill, research and development. We can talk about licenses. So licenses, and then even brand names. Okay, these are all intangible assets in relation to that. Now, what is the recognition criteria? Remember I told you when you pick any standard, you have to talk about these things, right? So what is the recognition criteria for intangible assets? Miriam is having a question. He said, software is also an example of intangible assets. Yes, that is true. Software is an intangible asset. So that is also part of it. So how do we recognize intangible assets? Recognition of intangible assets is the same as the property, plant, and equipment. The cost must be reliably measured, and it is probable that the future economic benefit of the asset will flow to the entity. Okay, so the cost must be reliably measured, and it's probable that the future economic benefit will flow to the entity. However, IAS 38 places more priority on the treatment of two key items, very importantly. So we need to also place priority on them, research and development, as well as goodwill. So how do we treat goodwill and how do we treat research and development? The standard IAS 38 places a high priority on these two items. So let's look at them. So goodwill. Now, when it comes to goodwill, the standard prohibits an entity from recognizing an internally generated goodwill. So companies are prohibited from recognizing internally generated goodwill, IGF. Entities are prohibited. What does that mean? It means that if, for instance, we sit down and say, okay, for our company, Premium Education Hub Limited, we will say that, okay, because of our YouTube channel, our Facebook pages, our blog, our podcast on iTunes, on Stitcher, all of that. Because of that, so the name Nhyira Premium, we will put a value on it and we'll say, okay, the value of Nhyira Premium, like as a goodwill, it's maybe $10,000, and we put that in our books. No. Internally generated goodwill cannot be recognized by the company. However, goodwill through acquisitions can be recognized by the organization. So goodwill recognizable should be through acquisition. That is why in consolidated financial statements, we recognize goodwill. Why? Because when there is an acquisition, there is a cash consideration that you are paying, or there is a consideration that you are paying. And the consideration you are paying, it's always going to be more, or chances are 9 out of 10, is going to be more than the net asset of the organization. So the difference is leading you to goodwill in relation to that. So the standard prohibits entity from recognizing internally generated goodwill, but allows entities to only recognize goodwill through acquisitions. So I cannot sit down and say, oh, because of what we are doing, Nhyira Premium should be $10,000 and we put it on the face of our financial statement. It cannot be done. But our trademark, that is the Nhyira Premium, registered as a trademark, that value will be recognized in the financial statement as part of our intangible assets, a brand name or trademark, because trademark is also an intangible asset in relation to that. So when it comes to goodwill, this is how we account for goodwill in relation to that. So internally generated goodwill, we are prohibited from accounting for it, but goodwill through acquisitions, the standard requires that it is accounted for in relation to that. Then the second item, research and development, R&D. Let me divide it here. So research is going to be here. I'm going to put development here. So research and development. Now, research simply has to do with an investigation undertaken by an entity to understand products, to improve upon products, or to develop a new product. The standard states that all research expenses must be written off in the year that they are incurred. So all research expenses must be written off, in the year that they are incurred. So that is the concept. However, the standard states that all capital expenditure incurred on research, must be capitalized and amortized over the useful life of the assets. All research expenses should be written off. However, all capital expenditure must be capitalized and written off and amortized over the useful life of the asset. Let me explain this. So let's say that we employ 10 people for them to do a research and ask people how our YouTube channel is helping people in Ghana and what we can do to improve upon the channel. So these 10 people we've employed, we've bought an iPad for them. So we have 10 iPads for them and we pay them, they are going to do the research for 2 months and we pay them an allowance every week of say $10,000 or $1,000 weekly allowance, okay, for the 10 people. In addition to that, we give them $200 every week as their TNT. So at the end of the day, the total cost we are going to be incurring for the 2 months, it's going to be research expenses. So the standard states that their salary, their TNT, these are recurrent expenditures. So those ones must be written off. during the year that we are we are undertaking the research. But the cost of the iPads, it's a capital expenditure. So we can't write it off because the iPad will not be used for only this research that we are undertaking, but the iPad will be used more than 1 year. For that reason, the cost of the iPad will be capitalized and we will amortize it over the economic useful life of the iPad. That is what we mean by research. I hope you get the principle. Then, after research findings, once the research makes a lot of sense, then the company goes to the second level, and that is going to be development. So development has to do with the use of research findings in order to improve upon an existing product or develop a product prototype. Development has to do with the use of research findings to improve upon an existing product or develop a new product prototype. The standard states that development expenses must be capitalized. Listen to this carefully. The standard states that development expenses must be capitalized. However, for a development expense to be capitalized, it must meet the following criteria. It is called sector. So for a development expenses to qualify or to be capitalized by the entity, it must meet the sector requirement. Now the S there simply means that it has to be a separately identifiable project. So separately identified projects in relation to that. That's the first thing. It means that we should be able to distinguish it between other things. So here we are dealing with the research on our YouTube channel. So definitely it's a separately identified asset in relation to that. Second, that the cost of the research can be reliably estimated. So estimation of cost reliably. So the cost of the research must be estimated reliably. That is the E, estimation of cost reliably. But not only that, okay, Richard J said written off. Written off simply means that we take it to the income statement as an expenses. So the research will debit the income statement straight up, and they will credit cash or bank. So when we say written off, it means you account for it as an expenses in the income statement. Richard, I hope you are okay about that. So the ones that are capital expenditure, you are going to debit property, plant, and equipment in relation to that. So when we say written off, it means you write it as an expenses in the income statement. So separately identify projects, estimation of cost reliably. C simply means that there should be a commercial value. In other words, there has to be a market for the product. How can you develop something that has no market? So there has to be a product, a commercial value of it in relation to that. So is there a ready market for what we are developing? That is the commercial value, because you can estimate the cost reliably, but if there is no market for it, you can't capitalize it. So until the entity decides or determines that, oh, there is now a market value for the product we are developing, any development cost we incur must be written off as an expenses in the income statement. But where the entity realizes that, oh, there is now a commercial value, it can start capitalizing. But not only that, T simply means technical feasibility. Technical feasibility. Is it something that we can do? Is this something that is doable? So technically, is it feasible as an organization? Can we do it? Do we have the know-how? Do we have the expertise? Can we do it? That is technical feasibility. Because there are some product ideas, they may not be, they may sound good, but the entity may not be able to do it because of where it is right now. So technical feasibility. Then the O means overall profitability. Remember, the main objective of the organization is to maximize the wealth of who? The shareholders. The fact that something has a commercial value, the fact that there is a market, a ready market for a product, does not mean we will make profits when we produce that product. Are you getting the idea? So overall profitability, there should be profit. It should be a profitable venture for us to go into in relation to that. Then the last one is that there is resources available to complete. There is resources available to complete. That is the R. All of the sector standards, or all of the sector must be met before a development expenses can be capitalized. If not, it must be written off. It is capitalized and amortized over the economic useful life determined by the entity. This is what we mean by the criteria for the recognition of development costs. Any questions, please? Any questions so far? So in the exam hall or in the question, you must ask yourself and you must identify the development cost that the company has incurred so far. Is there a ready market? Now, usually this is what is going to be happening. Separately identify, you may not see that in the question because it will be directly given. The cost will not be an issue, but what you have to be looking out for is this particular one. That is the commercial viability of the product. Commercial viability of the product, as well as the resource available to complete the product. So if the entity hasn't determined, like I mentioned, that there is a commercial market or there is a market for the product, then any cost incurred in the stage of development is written off. It's written off as an expenses. However, when they determine that, oh, now there is a commercial value for the product, there is a ready market for the product we are developing, from there, then the development expenses incurred will be capitalized and amortized over the useful life of the assets in relation to that. So according to IAS 38, these items are looked at differently. Goodwill. Internally generated goodwill, then it is prohibited that an entity will recognize it. But goodwill through acquisition can be recognized. When it comes to research also, entities must write off all research expenses incurred during the year of the research. However, all capital expenses incurred must be capitalized and amortized. When it comes to development cost, the standard states that development cost must be capitalized. However, before development cost or development expenses is capitalized, the sector criteria must be met. It should be a separately identified project. The cost should be reliably estimated. It must have a commercial value or ready market. It has to be technically feasible. It must be overall profitable, and we should have resources to complete the project in relation to that. So any questions, please? Any questions? Because of time constraints, I'm going to be concluding around here today for today's discussion. And we will continue tomorrow as well with the financial reporting standards. So tomorrow we're going to be looking at the part 3 of the financial reporting standards to continue with. Tomorrow is Friday. We will be looking at that as well. So tomorrow we will continue with this IAS 38 and IAS 36. Then I will also address other questions that you guys are having. So if you have any questions, please put it in the chat box. Let me reply to them quickly before I finally sign off for the day. Thank you very much for joining the stream today. It's such a privilege to come your way all the time. Ebenezer, Collins, Richard, Bernard, Michael, Tony, Foster, Miriam, Uche, Ignatius, John, Isaac, and all of you guys, thank you very much for taking time always to join me on the stream. My objective as always is to be able to provide you with the assistance that you need and explain the complex things that you are studying and make them very simple for you to be able to study and then prepare well for your examination. Foster Besios said thank you. You are welcome, Foster. Tofik Azuri said thank you. You are welcome. Gota Caleb said, God bless you, sir. God bless you too, Foster. Thank you very much for joining the stream today. So, God willing, tomorrow we're going to be continuing with this discussion. Remember, it's the Executive Revision Masterclass where I am picking key topics in the various subjects and to go through with you guys. Richard said, thanks so much. You are a good teacher. Thank you very much. It's a pleasure always. Miriam said, thank you very much, sir. God bless you. Amen. God bless you too, Miriam. Tony said, thank you. Very helpful. Then Isaac said, good night. Good night, Isaac, and take care of yourself as well. So thank you guys for joining the stream all the time. Tomorrow, same time, 4:30 p.m., we're going to be continuing with the IAS 38, and then I'll touch on IAS 36. Then I'll be looking at any other questions you have for me to touch on. Augustine Boatin said good night. Yeah, good night, Augustine. Augustine, yesterday I didn't hear from you. I believe you are doing well in relation to that. Uche said, God bless you, Nhyira. Amen, Uche. God bless you too. And you take care of yourself as well. Remember, coronavirus is still available. Did I say available? Coronavirus is still there, all right? And so please make sure you take care of yourself. When you go out, make sure you wear your nose mask or your face mask. Make sure you keep social distancing, sanitize your hands regularly, and take care of yourself, all right? So keep studying, keep working hard, and I'll see you same time tomorrow. I love you, and take care of yourself. Bye-bye. Tafik said hello to the kids in the background. All right. They will hear from you. Okay, Uche, bye.